So if you look in isolation, yesterday's price action, it will look outright ugly. Now extend it and say that, okay, what's been the 3-month trend? You would say that, look, this is an overdue correction which had to come and which simply has kicked in largely because of what has happened to the excess built up in the market. Now in isolation, yes, it was outright ugly. But all bull markets, they correct. It was simple law of gravity which was at play. I don't think the bull market is over. But what this kind of a correction will do, that if it will shake out the weak hands, it will test the temperament of leverage buyers. It will force you to think that equity as an asset class will have volatility and will have risk. I still feel that even though the shakeout will look outright ugly, you want to still avoid buying the big fall. I'll say it again. In a bull market, you should buy the fall. But in some of the overhyped sectors, especially some of the PSUs and some of the other overhyped sectors, I think you should wait for a couple of days before you plan your entry, because after such a rise, one day of fall may just not be good enough. So you got to take the market as it moves rather than prejudging an entry strategy. The bull market is not over. This market will give you entry points, but I think the entry points could be at lower levels rather than jumping the first wall. You know, Aisha, typically when you see a rally like this, the lot of FOMO crowd, lot of Johnny come lately crowd would say, okay, markets have corrected, now let's jump back in. I think the market is still overextended. The rise has been linear and it has been stupendous. You don't buy the first fall, but you want to be a buyer on the dip. I think the entry point will come maybe later this week or early next week, but you just got to time yourself very smartly if you miss some of these stocks. Yeah, but I'm horizon of 2 or 3 years, then there's nothing to worry. Then this will look like a seasonal correction. But this is a must overdue correction. It will shake out the weak players, it will give entry points, and finally strong players will kick in. That's how markets move.
Yeah, and you know, given how sharp the run-up in these spaces has been, the small and the mid caps, the correction may not stall here, right? I mean, like you were saying, for a long haul player, 10% may look like minuscule and par for the course, but because of the run-up and the swift run-up in these names, it's going to fall a lot more. It will get uglier before it gets pretty.
Yeah, technically what I understand is that if you look at the RSI levels, even after a 10% correction, they are still overbought. Yeah. If you look at the historical P multiples, after a 10% correction, they are not cheap. So either technically things have to just calm down a bit, or the stocks have to give you some kind of an appeal. I still maintain that these stocks are expensive. You must not buy the first fall. The bull market is not over, but the reason why you should not buy the first fall is because they have not become attractive enough even to be part of your long haul portfolio. Just wait it out for next couple of days. This is not going to be market technicals and the macro setup and what we understand when we speak to the market investors. This is not going to be a prolonged ugly correction, but it really could be Wednesday afternoon, or it really could be Thursday morning, it could be next Monday morning. Wait for a couple of days, let the dust settle down, let the calmness in the market come, rather than buying the first fall in terms of just participating.
Okay, a quick check-in on the global setup, and it was down in the range of about, a quiet card of 0.5% to about 1% across the board is what we witnessed. Asia as well, for the most part, is in the red and clearly eyeing some data coming in from the US in terms of the inflation numbers, and there's some data points from Japan and South Korea. For now, the GIFT Nifty indicates that it could be a minor positive start this morning. But just going by the other data points then, and as per Goldman Sachs as well, the overall cash levels for the top 200 active equity mutual funds, that stands at about 4.2% versus the long-term average of about 4.1%. The small and the mid-cap mandates hold high cash levels of about 5 to 7% in terms of the AUM, and the large cap schemes have about 3 to 4% in terms of their overall cash allocations. Just going by this kind of data, Nikunj, what according to you is this indicative of?
So what is the relevance of this data? The relevance of this data is that in the markets have run up, mutual funds are sitting on more than necessary cash, and you got NFOs which clearly are on right now. So this market is not going to get into any kind of a free fall zone unless something changes on the global macro front or the local front, which means that domestic institutional investors have enough and more cash, SIF flows are strong, and they are likely to be buyer, I wouldn't use the word buyer of last resort, but they are likely to be the backstop for this market. And if you have strong cash levels and strong flows, that means the downside in some of the institutional dominated stocks, I think will not be very large. Now what happens to HNI and retail dominated stocks? Well, that's a separate kettle of fish. But cash levels are decent. Maybe they've been waiting for declines, and if the decline kicks in, we've learned that the flow of domestic, the support of domestic flows, irrespective of the FI liquidity, I think is decent enough right now. Luckily, the NFOs and the flows into equity diversified schemes also is very decent enough. I mean, kudos to the retail guys. They know how to do risk management right now. So I don't think from a market liquidity standpoint, even if markets fall, there is going to be a crunch situation per se. Imagine if cash levels were low. Imagine if NFOs were not there. Imagine if SIPs were not picking up. Then you would have made then you could have made an argument for a liquidity vacuum. Right now, there is enough and more liquidity cushion in the market which will arrest the free fall until and unless something changes globally. I mean, what could change globally? A risk-off moment, something macro, I mean, a war-like situation. If those things don't happen, then you cannot make a case for a big free fall, at least in some of the quality mid-cap stocks and large-cap stocks.
Yeah, and that churn is clearly evident, right? Like we were talking yesterday, that banks could very well be the new defensives. You are seeing money flow into banks and even IT.
I think banks is the new defensives, and I would stick my neck out and say that in this rally, if something has scope and potential to outperform, I think it really would be banks. Variety of factors are at play right now. One, the cycle is just strong. B, the comfort level with institutional investors when it comes to investing into banks, I think is supreme. C, the valuations are no longer stretched. Fourth, they've underperformed. On the macro front, keep the crude part aside, but CPI inflation print yesterday seems to be coming down. Interest rate seems to be getting benign. There is no problem in terms of the balance sheet and what is happening there in terms of how things are moving. So the setup, valuation, underperformance, and the bent of the market is such that banks really could be defensive, new defensives. What are defensives? We're discussing this yesterday, Aisha. Defensives are the ones where you want to buy when the market is looking nervous or markets are looking at rotating. If there is one sector where defensives market will take comfort from, I think would be banks. The old definition of defensives was IT, pharma, consumer. Why? IT was a play on global outsourcing, consumer was a play on India consumption or demographics, and pharma was a play on outsourcing. But I think IT is shaky. Consumer stocks are expensive and divided because of rural versus urban, and pharma is a difficult sector to call. So what is defensives? Where you have comfort of earnings and visibility for next 2-3 years. I think for me that's banks now.
They cushion the impact, I guess, of the market volatility to a certain
extent. Yeah, Avan, in the last cycle, banks were not defensive because banks had all kind of crazy exposure, power, road, steel, and they were like the ugly duckling. Now it's a matter of timing, it's a nature of the economy. The ugly duckling, so to speak, has become the swan in the market.